Hi there. This video is the 8th of a series dedicated to my book Blockchain plus Antitrust, the decentralization formula. You can access all the chapters following the link in the description. Today, I want to explain how blockchain can suffer from collusion and what to do about it. First, let me take 2 minutes to start with the basics of collusion. Described as the supreme evil of antitrust, they make the majority of antitrust cases. As I explained in a previous video, a collusion is an agreement between at least two economic entities. This agreement needs not to be in a written form, it can be tacit. With that in mind, not all collusions are illegal, but they are when they centralize the market by eliminating competition, or, to quote the US Supreme Court, to eliminate the possibility of independent action. The same logic applies across all jurisdictions. Now, a first question I need to answer before entering blockchain is whether a blockchain can, in and of itself, be a collusion. After all, blockchains gather economic agents under the same rules. If the answer is positive, blockchains shall be prohibited, and we shall not be required to study further questions. Here, I need to distinguish between public and private blockchains and analyze whether the creation of such blockchains can create a negative impact on the market. I start with public blockchains, which are public. This means the information public blockchain contains is accessible to everyone. And this matters very much in the antitrust analysis. Generally, the exchange of public information is not considered an infringement of antitrust rules because it does not help competitors coordinate. The exchange of future prices or strategies is more problematic under US and EU competition law, but public blockchain does not display those. In a nutshell, public blockchains are agreements but not anti-competitive ones. This does not mean that they cannot be used for anti-competitive purposes, but their sole existence shall escape antitrust law. Okay, on to private blockchains now. As I explained in this series' second video, access to private blockchains is conditioned to getting a specific approval. This means the information it contains is not public. Now, of course, the incentive to adapt business strategies based on private information is higher than when using public information because not all competitors can change their behaviors accordingly. This means the creation of private blockchains could be seen as problematic. For that reason, agencies will sure study conditions of access to private blockchains. If they are too restrictive, and if information it contains is too sensible, antitrust will be enforced. Now, the second question I want to address in this video concerns collusion impacting blockchains. Here, I distinguish between the agreements that concerns the operation of blockchains on the one hand, and those that concerns the modification of blockchains on the other. As far as the operation of blockchain goes, I see three fundamental types of decisions. The first relates to entry. Public blockchains are open door, meaning that they don't create problems in that regard. But private blockchains are closed doors, meaning that they do create an antitrust concern. And that's not all. Entry to facilities outside the blockchain can also create an antitrust issue. The very first case of blockchain antitrust, Gallagher versus BitcoinTalk.org, is all about that. In this case, a blockchain developer named Ryan Gallagher was kicked out of the BitcoinTalk.org forum. He argued that because of this decision, it became impossible for him to access great blockchain developers, put a new blockchain out there, and compete with Bitcoin. He said BitcoinTalk.org colluded with the Bitcoin Foundation and infringed antitrust law. Long story short, Ryan Gallagher lost his case for different reasons. In any case, it would have been extremely hard to prove that access to this one forum was essential to compete. But the logic is interesting. Access to outside blockchain infrastructures can have an impact inside the chain. I expect more cases of this nature. The second practice concerning blockchain operation concerns the consensus. The consensus embodies the rules according to which blockchain transactions can be validated. Although no consensus mechanism should be anti-competitive in itself, I believe that some of them can facilitate the emergence of anti-competitive practices. Let me make my points by discussing two of them. As I previously explained, proof of work requires an important computational power. This leads blockchain miners to create pools, which are often recorded companies. These companies can have an email address, a phone number, etc. They can easily identify each other and coordinate. Proof of stake prioritizes users with the most tokens. Although blockchain users can see where tokens are located, they often do not know who is behind the wallet and therefore how to get in touch with them. Collusion is less likely. The third type of practices about blockchain operation relates to the fees and rewards. When miners validate transactions, they get a reward. The reward, depending on blockchains, is a tiny fraction of the transaction itself, freshly minted tokens, or a combination of the two. Here again, no fee structure shall be anti-competitive in itself, but they can manifest an anti-competitive practice. Two blockchains could set up their fee structure in an identical fashion. They could also attack another blockchain to change its fee structure. In a nutshell, antitrust agencies will sure question why the fee structure of a blockchain is such as it is. Okay, we now enter the last part of this video, blockchain modification. Here also, I see three types of decisions. The first relates to the core clients. Core developers could be tempted to propose modification to the core software in a way to collude with another blockchain or to benefit their own interest while hurting all the other blockchain participants. As I explained, core developers cannot change the code on their own, but they can strongly influence modifications. If I take Bitcoin as an example, they release Bitcoin improvement proposals, and blockchain participants can vote by raising flags. The more computational power, the more flags a user has. This could amount to collusion, and in the case of a private blockchain, core developers can often change the rules as they please. This means that implementing practices that benefit only them is much easier. In different words, lawyers need to understand the technical functioning of each blockchain. Let me give you a concrete example of why this is key. In late 2019, 4 legal actions were filed by crypto investors over alleged manipulation of the cryptocurrency Tether and the exchange Bitfinex. According to the plaintiff, Tether's core developers issued 2.8 billion Tether tokens between 2017 and 2019 with the ambition to float the Bitfinex exchange. Tether's core developers argued at the time that 1 Tether equaled $1, when in fact this wasn't true. The CFTC already sanctioned them in September 2021 for misleading investors about that. But in fact, after this was revealed in 2018, the bubble eventually burst and $466 billion in value were lost in less than a month. The people who invested in crypto right before are now suing Tether core developer under Section 2 of the Sherman Act for over $1.4 trillion in damages. This is how important blockchain design can be and how big blockchain antitrust is. The second type of blockchain modification relates to forks. A fork occurs when the rules are changed. If all participants agree on the change, they all update their software to the new version and keep using the same blockchain. But if one part of blockchain participants do not agree, they will keep following the original rules, while other participants will follow the new ones. In such a scenario, the blockchain will split in 2 separate blockchains. Here again, a case, United American Corp versus Bitmain, helps us better understand the issues at stake. Users of the Bitcoin Cash blockchain disagreed on the size of the blocks. Some wanted few transactions per block as it requires less computing power to validate and decentralize mining activities. Others wanted larger blocks to facilitate blockchain scalability by ensuring that transactions were validated faster. So they forked the blockchain and applied new rules to their version. Within minutes, the company Bitmain redirected its mining power toward that new version. The objective, it seems, was to exceed United American Corp's mining power and thus motivate a majority of users to join the new chain. They eventually succeeded. Users of the original chain sued users of the new one, arguing that they infringed antitrust laws by colluding. After all, several users came together, forked the blockchain on purpose, and divided the original value. But the court dismissed all the claims. As it appears in the decision, the plaintiff could not show that the group who forked the blockchain and Bitmain ever had an agreement. This was the end of the case, but let us push the logic further. Even if such an agreement ever existed, would it be anti-competitive? Well, in my view, it depends. When blockchain participants fork a blockchain and create a split because other users resist the fork, they are creating new competition. This can't be anti-competitive in itself. However, the fork can be anti-competitive when it is proven successful, not because blockchain participants are adopting it, but because of a manipulation. For example, should participants rent computing power for just a few days, time to convince the fork is successful and that everyone should move on to it, I could see why the fork will be anti-competitive, not in itself, but in the way it was implemented. Okay, time to move on to the last item of this rich video and discuss blockchain applications. Let me tell you a quick story. In June 2016, someone discovered a bug in the smart contract governing the DAO, a decentralized autonomous organization. One user signed over 3.6 million Ether, but thanks to the DAO design, these tokens had been frozen for 28 days before being permanently transferred. A lively debate ensued within the Ethereum community regarding the necessity to fork the blockchain and change the smart contract. A vast majority agreed. The blockchain was eventually forked and the stolen tokens were recovered. That story is interesting because it shows that changes in blockchain infrastructure impact upper levels. One can imagine that it won't always be done to protect blockchain best interest, but sometimes to abuse it. This will open the door to antitrust enforcement. That is all for today. Thank you very much for listening. Take care of yourself, and if you can, someone else too. Cheers.